Hello everyone. Today we are starting a brand new series, a slight deviation from the usual new launch project reviews because we have realized something important. Consumers today don't lack information. In fact, there's too much of it. Everywhere you look, there are opinions, headlines, numbers, and noise. And while information is meant to help, too much of it often creates the opposite effect: confusion, paralysis, and uncertainty of what's actually happening right for you. I saw this firsthand recently. A buyer for my HDB flat relied on AI to understand the CPF housing grants, but the source used was outdated. As a result, they had to redo their HDB flat eligibility process. Thankfully, the seller was willing to wait for the HFE to be regenerated and go through the entire option period again. This highlights an important point. People don't just need more content, they need clarity, they need context, they need a framework to make confident decisions. That's exactly why we created this series. Welcome to the Capital Lens, where we decode Singapore's property market so you can see opportunities clearly, understand risks properly, and make smarter moves with confidence. Singapore government just released a number most people ignored, and it may explain why property matters more than ever. For the first time, measure of wealth inequality has been published and is higher than income equality. Why should this matter to everyday Singaporeans? Because higher wealth inequality often means an uneven distribution of total net worth, which includes assets like property, savings, and investments minus debt. It signifies a gap in accumulated assets. And as Ministry of Finance also highlighted in the article, wealth can be entrenched across generations, as households with greater resources are better able to invest in and transfer assets to their children. I think this is what we always see in day-to-day. We see that a lot of parents have been assisting their kids with the down payment or even supporting them to attain a higher loan amount. And actually, if we think about it, would parents prefer to give something that is usable, like a house, or would they give money to support their stock portfolio investment? And one of the clearest takeaways from the article was this. Across the household wealth spectrum, property makes up the biggest share of assets for many families. Oftentimes it's 50% across all income groups. Because no matter where a household stands on the wealth ladder, property often sits right at the center of their finances. And that is why having clarity on the home you own matters so much. If your property is one of your biggest assets, decisions around it should never be made casually. Questions like, is this home still suitable for your current stage of life? Is it giving you flexibility or stretching your finances? Does it have the ability to hold value over time? Is it too much of your wealth tied up in one property? Would staying, upgrading, right-sizing or restructuring put you in a better position? These are not just housing questions. They are wealth questions because for many families, understanding the home they live in also means understanding a big part of their financial future. And this is exactly why the Capital Lens matters. It is a framework we have consistently relied on to evaluate property decisions through a widened lens, not only the price on paper, but the logic behind the move, the risks involved, and the long-term outcome it may create. At different stages of life, the property can be a key wealth asset, a stepping stone to the next move, a source of security, a means to retirement, or a drag on finances if bought wrongly. That's why we need to look at property holistically, not based on hype, not based on fear of missing out, not just because everyone else is buying. So how do we assess? We assess a property through 3 pillars. The first pillar is how to build capital. When people talk about building capital through property, the first question is usually, will this property make money? That is understandable, but the truth is no one can genuinely promise profits. Markets move, policies change, interest rates shift, and timing always matters. So instead of chasing guaranteed gains, a better question to ask is, what number am I actually working towards? Because building capital should not be based on hope, it should be based on purpose. For many people, that number is linked to retirement. How much do you need to maintain your lifestyle when you stop working? How much passive income or usable assets would give you a peace of mind? At retirement, it is usually prudent for major loans to be fully paid up. For example, If your home makes up 50% of your total assets, then it may be worth asking, is it too much wealth tied up into one asset? And will this asset generate income? Or is my value already locked in? Does it make sense to right size now? Does this property support my retirement goals? Or is just a valuation on paper? A person can be asset rich but still cash tight. So building capital is not simply buying any property and hoping price rise. It's about owning the right asset and moving steadily towards a number that supports your future and your retirement. The second pillar, preserving capital, is about protecting what you have already built. This means paying close attention to downside risks. How is your property likely to perform over the period you intend to hold it? Will it remain resilient or could it underperform over time? Because one of the biggest risks is not always a sharp price drop. Sometimes it is when the real value of your asset quietly falls over time while inflation keeps rising. For example, a chicken rice today can be $5, but in the future, $7, $8, or even $10. So even if your property price stays the same on paper, your purchasing power may have gone backwards. That means your asset may look stable nominally, but weaker in real terms. This is why preserving capital is not just about avoiding losses. It's ensuring that the wealth you work hard to build does not slowly erode without you realizing it. And finally, deploying capital is about knowing when, where, and how much to commit, because the right opportunity at the wrong affordability level can still become the wrong move. Many people think deployment is only about timing the market, but just as important is whether the move is sustainable for your finances. Can you comfortably service the loan? Do you have buffers for emergencies? And will this purchase strain your monthly cash flow? And are you relying on everything going perfectly? Sometimes the smartest deployment is to move decisively. Sometimes it is to wait, strengthen your finances, and enter later from a better position. Sometimes it is to right size and redeploy your capital elsewhere. Because deployment is not about buying the most expensive asset you can qualify for. It's about placing your capital into the right move without compromising stability. Within the pillar of building capital, we will look at the key factors that can influence long-term upside. This includes government policies, transformation and growth, demand drivers that support future value. Within the pillars of preserving capital, we focus on the factors of supply and demand of the district and the development, buyer pool, lease decay, layout, rental yield. And within the pillar of deploying capital, we look at the wider market context and whether the move makes sense at this point in time, including leading and lagging indicators. We also examine the entry price, affordability, and whether it is a strategic fit for your current goals and financial position. As we assess whether a property is the right fit, these three pillars cover many of the key factors that can shape your overall property position. So over this series, we'll take the time to unpack each one properly and show how they apply in real-life decisions. If you'd like to understand the Singapore property market in a clearer and more strategic way, remember to like, share and subscribe, and stay tuned for the upcoming series of videos.